So I know that you've heard of girl math.
Tyler, the home loan guy here, and my wife wants to explain what girl math is.
Okay, so my version of girl math is if I return something to the store, I'm making money. It's like essentially it's cash flow.
No,
It's
that's not how that
it's
works.
positive
Nope.
coming into me. If I buy something with cash, it's free. Cash is like free money.
No.
It's like it never happened.
Nope, it still costs something.
No, it's free.
And you've also heard of boy math.
Boy math is how 5'10" measures 6 foot.
Yeah, that's boy math to be fair.
Yes, yeah. But we haven't got a choice though.
Yeah, we have.
That's involuntary boy math.
Yeah.
You leave us no choice.
Yeah.
So today I'm going to teach you about real estate investor math. So this is how real estate investor math goes. 1 equals 4. Follow me so far? And 200,000 equals 387,000. And last one, 800 equals 800. That one should be the easiest.
It makes so much sense now.
All right, so what does this mean? Let me break it down for you and explain how to do real estate investor math. Back in 2016, my business partner and I purchased a house in Santan Valley, Arizona. And this house was a really interesting house, okay? We bought it for $110,000. The reason that I say it was interesting is because it was half manufactured home, half stick-built home. So the property was titled as a manufactured home on land, but yet it had a whole lot more to it that was stick-built. So this is what we did. We purchased the property for $110,000. It was really discounted because of this weird kind of configuration. Well, we went in and we kind of tore out the manufactured home part, at least most of it, and we were able to open the wall, and we got a structural engineer in there to help us be able to do everything correctly. But we went ahead and we did that, and we ended up putting in about $100,000 worth of repairs on this property. And again, we bought it back in 2016, and we just sold that property a few months ago. And we sold it to a buddy of mine who had done work for me, who was living in the property, and he exercised the lease option. And if you don't know what the lease option is, go ahead and check out my videos on lease options. I have a ton of them. That's an area of real estate that I do a lot of. And the guy that bought the house is the same guy who built the whole rock formation for my pool. So if anybody wants a really cool rock formation like this one, then go ahead and reach out to my guy JP or JePierre. He created my rock formation and he flies all around the country creating awesome rock formations for people. Anyway, so let me get back to the details. He purchased the property from us for $410,000. And he bought the property on a street called Bonnie. So I'm going to go ahead and put up the numbers here so we can follow along. So Bonnie cost $110,000 to purchase. And then we put $100,000 of repairs into the property. And then we just sold it recently for $410,000. So we bought it at 110, put 100 in fixing it, sold it for $410,000. So our total profit on this property was $200,000. So we got $200,000 from the sale of Bonnie. Now, if I were to have sold Bonnie and taken that $200,000 of profit and put it into my account, then I would have had to pay what's called long-term capital gains tax. And that tax could be anywhere between like 15 and 20%, sometimes a little bit more. It just really depends on your tax brackets, kind of where that number lies. But let's just say that I probably would have had to pay about $40,000 of taxes if I had just had that money come to me. But instead of that, I had this money go to a friend of mine named Dave Foster, and he's out in Florida, and he is a 1031 exchange specialist. So what is a 1031 exchange? A 1031 exchange is a part of the tax code that basically says, rather than selling an asset and taking that money, I can go ahead and sell that asset and put that money with somebody else, and then I can take that money and buy another asset without that money ever coming to me. So it's a way of trading one asset for another asset that's like that without occurring a taxable event. So this way, rather than taking that money and paying the $40,000 of taxes and then reinvesting $160,000, I was able to put that into a 1031 exchange and then reinvest all $200,000. Now, eventually, I will need to pay those taxes, but rather than paying it now, I can take that $40,000 and I can reinvest it, and that $40,000 can create a lot more money. So there's a lot of benefit in doing a 1031 exchange. So rather than that money coming to me, I had that money go to my good friend, Dave Foster. And Dave Foster is a 1031 exchange specialist. He does a fantastic job. So if anybody wants to learn how to do a 1031 exchange and wants to do it with somebody, I would definitely recommend Dave Foster. I'll put his information in the description below, along with my rock formation guide, JePierre. Okay, let's keep going. So that $200,000 goes with Dave Foster. And then what I do is quickly after selling the property, I bought 2 other properties. One property on a street called Millet, okay? So let's say Millet right here. Now, I bought this property from a wholesaler, and I was able to buy that property for $315,000. This property actually was in really good shape, and so when I bought it, I didn't have to do any rehab. And in order to buy it, I took $54,000 of the $200,000 and I put it towards the down payment of this property. So $54,000 of that $200,000 went right here. So I'm going to break this down into 54 and $146,000. Now I got an appraisal for the property on Millet when I bought it, and the appraisal actually came in at $395,000, which was fantastic, right? So just the difference between what I'm buying it for and what it's worth is an $80,000 difference. Now you might wonder, how is it that I was able to buy a property for $80,000 below market value? Well, there's a couple of reasons. One, I work a lot with wholesalers, and wholesalers go out and they find properties that they're able to get under market value, and people are willing to sell those properties for less than the market for, various reasons. Usually it's because the property has some problems with it, or sometimes the seller themselves have some issues and they're not able to sell the property for market value, or they need to get the money quickly. There's a lot of reasons why they would want to sell it with a wholesaler. So I bought it from the wholesaler at $315 and the value was at $395. But I didn't want to get a loan for more than $250,000. So even though I bought it for $315 and I had $54,000 going towards the purchase, I needed to bring in another $11,000 of my own money in order to get a loan for $250,000. So that's the thing that's important. So I got a loan for $250,000, and I brought $54,000 from the $200 and $11,000 of my own money, plus some other money for the closing costs. So just remember that there's closing costs whenever you buy a property. This property, I actually didn't do a refinance. This was a straight purchase. So I only had to pay one set of closing costs. And the person that lived in this property, they wanted to continue to live in it for about a year. And so I did a lease agreement with them so that they could stay there for a year after I purchased it from them. So one thing that's great about the 1031 exchange is that you can take a property, sell it, and you can either buy another property that has the same amount of equity or greater, as long as you use all of the proceeds that you would have gotten, or sometimes you can actually buy multiple properties, which is what I did in this situation. So this was the first property I bought. The next property I bought was on a street called Bobcat. And I found this property through a wholesaler, and I bought it for $146,000. Now, it may make sense why I split this into $54,000 and $146,000, because I took the rest of this $146,000 and I bought this property in cash. So I brought in $146,000 to buy this property in cash, and this property got valued at $176,000 right when I bought it. So I was able to buy it $30,000 below the market value. Now, after I bought the property on Bobcat, I had to wait a little bit because the tenant was going to remain in there for about 30 days. So as soon as they moved out, then we went in and we did a good cleaning, but the property was in pretty good condition. So I didn't have to do really anything besides just clean it and maybe just a tiny bit of repairs. So I got that property ready for somebody to come in and do a lease with the option to buy in order to be a homeowner on that property. And after I did that, I then had a lease and I was able to go to the bank and tell the banker I would like to do a cash out refi for this property. And the bank was willing to give me $104,000 for that cash out refinance. Now you might wonder, well, why didn't I just get a loan with it from the beginning? Remember, when you're doing a 1031 exchange, you need to take all of the proceeds that you get from that last property and you need to reinvest them. Otherwise, you're going to need to pay taxes on that portion that comes to you without reinvesting it. So when I bought it all in cash, and the value of this property plus this property was greater than the $410,000 that I sold on Bonnie, right? It was greater than this amount. And then I invested all $200,000 of the proceeds which came to me. But then after I closed on both of those deals, I then went to the bank and I said, hey banker, I have this property that's free and clear. Will you give me a loan on it? The banker said, sure. And he gave me $104,000 on that property. Now you might think, well, shouldn't the banker have given you more? Well, this is actually a manufactured home. And so a lot of the manufactured home loans that I get on investment properties are about a 60 to 65% loan to value. And when I get a loan on like a stick-built home, then I'm usually able to get between 70 and 80% loan to value. And it's pretty hard to find a bank that's willing to give you a loan on a manufactured home. But because I have a lot of loans with this bank and they're a local bank, I've worked with them pretty well and they're willing to give me those types of loans. So now this is where it gets more creative. I took that $104,000 and I was able to buy 2 more properties with it. So I bought a property on a street called Desert Agave, and we're gonna call this Desert Agave 1 because I bought another property just a few doors down on the same street. So Desert Agave 1, I bought this property for $260,000. This property needed new carpet, the kitchen was old and dated, and so I redid the kitchen and I put new carpet in, I painted it, and then I also updated the bathrooms. And I did all of that for about $15,000 because the property was actually in pretty good condition. So I bought it for $260,000, I put about $15,000 into it. And when I bought it, I had to pay closing costs when I bought it. And then when I refinanced it, I had to pay another set of closing costs. But once it was finished, I found a tenant that wanted to come in and be a homeowner. And so they moved into the home as a lease option tenant. So they moved into the home and got a lease and then got an option to buy the property within the next 3 years. So when I bought the property with a hard money loan. And the hard money lender was willing to give me a loan for $220,000 plus money for the rehab. So he was going to give me in total about $250,000 for this loan. So when we went to go get the long-term loan with the bank ordered an appraisal and the appraiser came out and he appraised the property for just less than $330,000. So let's put that here, $330,000. That was the value that came in after I went and I put those repairs in and everything like that. So you had this and this plus about $15,000 of closing costs on both ends. And my all-in was about $290,000. So $290,000 and the value of the property was $330,000. So I was able to create $40,000 of equity in this deal. And I got the loan for $250,000, which means that I had to leave $40,000 into this deal. So where did I get that $40,000? Remember, I went and I got $104,000 from the refinance of Bobcat, and $40,000 of that went into this deal right here. So $40,000 stays in the property, plus the loan for $250,000 equals my all-in of $290,000. Then shortly after getting this property, I bought the other property on Desert Agave. So we're gonna call that Desert Agave 2. I bought this property for $235,000 because it just needed a lot more repairs than the first one did. So the total cost in repairs was about $35,000. Okay, so $35,000. And then when you take the closing costs of when I purchased it, and then the closing costs of when I got it refinanced, and you add that with the holding costs, it was about $20,000 for all of those costs. So when you add it all up together, I was in this property for another $290,000. But this was also a bigger property, and so it appraised at $340,000. And when I went to the bank to go get a loan, again, right now I'm trying to get loans for about $250,000. So I got another loan for $250,000. And because my all-in was $290,000, I had to leave another $40,000 into this deal. So there's my $40,000, and where did I get that $40,000? Again, I got it from the refinance right here. And so you take the $104,000 minus the $40,000 for Desert Agave 1 and the other $40,000 for Desert Agave 2, and I had an additional $24,000. But in all honesty, part of that $24,000 went to the refinancing of Bobcat, and the rest of it went to this $11,000 for Millet that I had to take out of my pocket, which ultimately meant that I was able to take that $200,000 and I was able to buy properties without bringing in much more money than that $200,000 that I got from the sale of Bonnie. So now let's take a look and see how much equity was created through this whole 1031 exchange. Remember, we started out with $200,000, and then in Millet it was valued at $395,000. So we take our loan amount, which is $250,000, and we minus the value right here of $395,000. And so the equity that was created in Millet was $145,000 of equity. Now let's take a look at Bobcat. So we have a loan for Bobcat for $104,000, and the value is $176,000. And so you subtract that, and we're going to get $72,000 of equity for Bobcat. Now let's take a look at Desert Agave 1. So we have a loan for $250,000. The value is $330,000. And so we created $80,000 of equity on Desert Agave 1. Now let's take a look at Desert Agave 2. So we have a loan for $250,000. The value is $340,000. So we were able to create $90,000 of equity for Desert Agave 2. So if you take all four of these properties and you add up all four of them, it equals $387,000. So that's what real estate investor math is. You take one property and you're able to make it become four properties. You're able to take $200,000 of equity and you're able to transform it into $387,000 of equity. And then what's the 800 equals 800? Well, to be honest, when I had Bonnie, I had purchased it with really low interest rates. Back in 2016 is when I purchased it, but I also refinanced it, I think back in 2021. And so I had a really low interest rate with that property. And that was the same time when a lot of the rent rates were going up. And so what I was getting in rent every month, minus what I had to pay every month, I was cash flowing about $800 per month on Bonnie. Now, all four of these properties have high interest rates right now. And so I'm only cash flowing about $200 a month per property. Now, that doesn't bother me too much because remember, these are lease option properties. And with lease option properties, the tenants take care of the majority of the things that go wrong with the property, if anything goes wrong with them. But I went in and I made sure that these properties were good properties and they were functioning well, and I did some rehab on these ones. So all of the major mechanical things are going fine. But because the interest rates are really high right now, I'm only making about $200 a month on each of these properties. So you take 200, you times it by 4, and that equals another $800. So tell me, would you be willing to trade one property that's making $800 for 4 properties that are making $800 a month? Well, what if you could take your $200,000 of equity and almost double it by spreading that out amongst 4 properties? And not only that, but what happens when interest rates come down, which I think they will come down? As they come down, what happens to all 4 of these properties? They go up. And these 4 properties are on what's called a floating lease option, which means that they can buy them for the strike price that I put on there, which is about 10% higher than the value is today of each of the properties, or whatever the property appraises for, whichever is higher. And I learned to do that because during COVID, when all of these prices started to skyrocket, a lot of the lease option buyers were able to buy their properties from me for like $50,000 or even $100,000 below market value. I learned from a guy named Chris Crone about creating what's called a floating lease option, which helps me not give away all of that equity that could come if we start to experience a lot of inflation. but it's still advantageous to the tenant buyer because they're the only ones that can buy the property within that time frame. And when they come in and they give me an option fee, then I take that option fee and I can help them pay for some of their closing costs when they go to buy the property. And I've had dozens of people exercise their option with me, and they're all really, really grateful that they were able to get into a property and become a homeowner. And so one thing I've done in order to advertise for my lease options is I created a website called ArizonaLeaseOptions.com where people can go and take a look at the lease option properties that I have available. And that's been one thing that's really helped us be able to advertise our lease option properties. So hopefully this video is more helpful for you than learning about boy math and girl math. Hopefully learning about real estate investor math can actually create wealth for you. So thanks for watching. If you have any questions, go ahead and put them down in the show notes below, and I'll do my best to answer them. And I want to wish you a great day and good luck investing in real estate.